The global economy is sitting on a time bomb, and it's ticking. The grand total? Nearly $346 trillion. That isn't just a number, it's a flashing red warning light, the same kind that has lit up right before some of the most devastating financial crashes in modern history. For years, we've been told that we can just borrow our way to prosperity, that piling on more and more debt is the only way to keep the economic engine running. But what happens when the bill finally comes due? What happens when the very fuel that powered the markets turns into the explosive that brings the whole system crashing down? Because right now, just beneath the surface of record high stock prices and bold proclamations of economic strength, a fragile and dangerous reality is taking shape. The entire market is floating on an unprecedented bubble of borrowed money. This isn't just a new record. It's a massive warning sign that has appeared right before the biggest market crashes of the last century. We are in a situation that looks eerily similar to the days just before 1929, 2000, and 2008. When this debt bomb inevitably explodes, it's going to trigger a cascade of forced selling that you need to be ready for. This isn't about spreading fear. It's about understanding the mechanics of the market you're in. Today, we're going to break down the anatomy of this debt bomb, look at the historical precedents that are screaming a warning at us, and talk about what you need to know to prepare for the fallout. So let's get specific. When we talk about this mountain of debt, what are we really looking at? Well, it's a three-headed monster: government debt, corporate debt, and consumer debt. And all three are flashing bright red. Let's start with the big one: government debt. As of late 2025, the US national debt has ballooned to a staggering $38.4 trillion. To put that in perspective, that number has shot up by over $2.2 trillion in just the last year. That's an average of $6.12 billion per day. By the time you finish watching this video, the US government will have tacked on millions more. For a long time, the argument was that none of this mattered because interest rates were practically zero. The government could borrow for free. But those days are long gone. The average interest rate on this massive pile of debt is no longer a rounding error. As a result, the cost to simply service this debt, not even pay it down, just cover the interest, is exploding. In the 12 months leading up to October 2025, the United States paid an almost unbelievable $981 billion in net interest alone. Just 5 years ago, in 2020, that figure was $345 billion. It has nearly tripled. Think about that. We are now spending close to $1 trillion a year just on interest. That's more than the entire national defense budget. It's more than we spend on Medicare. This is what economists call a debt spiral. As the debt grows, the interest payments get bigger. To make those higher interest payments, the government has to borrow even more money, which makes the debt even larger, which in turn makes the next round of interest payments even higher. It's a vicious cycle, and with every turn, the system becomes more and more unstable. The Congressional Budget Office projects this will only get worse, with interest payments eating up more and more of all government spending for years to come. But it's not just governments. The corporate world is also swimming in leverage. Global non-financial corporate debt is now fast approaching the $100 trillion mark. Companies, especially in hot sectors like AI and clean energy, have been borrowing aggressively, fueled by years of easy money. While that can juice earnings and stock prices in the short term, it leaves these companies incredibly vulnerable. When borrowing costs rise or the economy slows down, their profits can evaporate overnight, as they suddenly have to pay more for the very debt that funded their growth. And while global household debt has remained a bit more stable compared to the size of the economy, it still stands at nearly $64 trillion. In an economy with high inflation and rising costs, many families are stretched thin, and any economic shock could easily tip millions into default. So you have governments, corporations, and individuals all leveraged up to historic levels. The entire foundation of the global economy is built on borrowed money. Now, let's add the accelerant to the fire. If that massive pile of public and private debt is the dynamite, then margin debt is the gasoline poured all over it. For anyone not familiar, margin debt is money that investors borrow from their brokers to buy more stocks. It's pure, unadulterated leverage. It amplifies your gains, but it also amplifies your losses, and it is perhaps the single most important indicator of speculative fever in the market. As of late 2025, U.S. margin debt has surged to a record-breaking $1.18 trillion. This isn't a small increase. It represents one of the most aggressive buildups of leverage we have ever seen. The year-over-year growth has been an astonishing 45%. This tells us that investors aren't just optimistic. They are euphoric, borrowing hand over fist to chase returns in a market they believe can only go up. History shows us this is a classic textbook warning sign. Every single major spike in margin debt, in 1999 right before the dot-com bust, in 2007 right before the financial crisis, and again in 2021 before the 2022 sell-off, was followed by a painful market crash. When leverage peaks, a correction tends to follow. Why is this so dangerous? Because margin debt creates a built-in, automated selling machine. When the market starts to fall, investors who have borrowed heavily get a margin call from their broker. This is a demand for more cash to cover their losses. If they can't come up with the cash, the broker is forced to sell their stocks to get their money back. This is where the cascade begins. One person's forced selling pushes stock prices down. That drop triggers margin calls for another group of investors. Their forced selling pushes prices down even more. This chain reaction is how a normal, healthy 5 to 10% correction can turn into a devastating 30%, 40%, or even 50% crash seemingly overnight. At that point, it's no longer driven by fundamentals. It's driven by a mechanical, self-reinforcing cycle of forced liquidations. And margin debt isn't the only sign of dangerous speculation. We're seeing it everywhere. Take a look at valuation metrics. The so-called Buffett indicator, which compares the total value of the stock market to the nation's GDP, is screaming a warning. As of December 2025, the indicator stands at over 220%. Warren Buffett himself has said that a level around 200% should be a major red flag, calling it probably the best single measure of where valuations stand at any given moment. Right now, it's telling us that the market is severely detached from the real economy. We are in a speculative frenzy, fueled by borrowed money, that is pushing asset prices to levels completely untethered from reality. This is precisely the kind of environment that precedes a major crash. It's not a question of if this bubble will pop, but what will be the pin that finally pops it. And to understand what that looks like, we only need to look back at history. If any of this is starting to sound familiar, it's because we have seen this movie before. The script is almost identical. Let's walk through the 3 biggest crashes of the last century and see how they mirror the situation we're in today. First, let's go back to the Roaring '20s and the Great Crash of 1929. The decade leading up to it was a time of huge optimism and technological innovation, much like today. But bubbling just under the surface was an unprecedented expansion of credit. Everyday people were encouraged to buy stocks on margin, sometimes putting down as little as 10 cents for every dollar's worth of stock they bought. This explosion of leverage sent the market soaring to dizzying heights. But when the market began to wobble in October 1929, the very same leverage that created the boom became the engine of its destruction. The first wave of selling triggered margin calls. Those who couldn't pay were sold out, pushing prices lower and triggering a fresh wave of margin calls. It was a domino effect. This cascade of forced selling turned a market downturn into a full-blown collapse, wiping out fortunes and ushering in the Great Depression. The parallel to today's record margin debt is impossible to ignore. Now, let's fast forward to the year 2000 and the dot-com bubble. Again, we had a period of revolutionary technology, the internet, that was fueling a speculative mania. Investors, convinced that this time was different, poured money into any company with a .com at the end of its name, whether it had profits or even a viable business plan. And how did they fund this speculation? Once again, through a massive increase in leverage. Margin debt soared in 1999, hitting what was then a record high. Investors borrowed heavily to buy more and more tech stocks, convinced they had found the key to infinite riches. The narrative today around artificial intelligence has an eerie echo of this period. We see a similar gold rush into a new wonder technology with valuations that defy all traditional logic. When the dot-com bubble finally burst in March of 2000, it was the same old story. As tech stocks began to fall, the margin calls went out. The forced selling began, and the NASDAQ, which was the epicenter of the bubble, collapsed by nearly 80% over the next 2 years. The speculative mania, fueled by borrowed money, had once again led to a devastating crash. Finally, we have the most recent and perhaps most relevant example, the 2008 global financial crisis. This time, the debt wasn't just in the stock market, it was in the housing market. But the underlying mechanics were identical: excessive leverage creating a system-wide risk. For years, banks had been handing out mortgages with little to no real vetting. This easy credit created a massive housing bubble. These risky mortgages were then packaged into complex financial instruments called collateralized debt obligations, or CDOs, and sold to investors all over the world. These were debt bombs, layered on top of other debt bombs. When the housing market finally turned and homeowners began to default, the value of these CDOs collapsed. This triggered a financial heart attack. Banks and financial institutions that were loaded up on these toxic assets, leveraged to the hilt, suddenly found themselves insolvent. The failure of Lehman Brothers in September 2008 set off a panic, a global contagion of fear and forced selling that brought the entire financial system to its knees. 1929, 2000, 2008. 3 different decades, 3 different stories, but one common thread: a massive buildup of debt and leverage that made the entire system fragile. In each case, when the bubble finally popped, the crash wasn't a slow decline. It was a rapid, violent cascade of forced selling. That is the lesson history teaches us, and it's a lesson we seem determined to ignore. A bomb, no matter how powerful, is harmless without a detonator. Our current financial system is a bomb, packed with the high explosives of government, corporate, and speculative debt. So what's the trigger that could set it all off? It could be one of several things, and they are all looming on the horizon. The most obvious trigger is interest rates staying higher for longer than the market expects. For over a decade, the global economy was addicted to 0% interest rates. This made borrowing almost free and encouraged the massive buildup of debt we've just talked about. Now that central banks have been forced to raise rates to fight inflation, the cost of servicing all that debt is becoming unbearable. For a heavily indebted company, an interest rate hike from 3% to 5% isn't a small tweak. It can be the difference between making a profit and going bankrupt. For a government already spending $1 trillion on interest, it means borrowing even faster, accelerating that debt spiral. Every rate hike is another turn of the screw, putting more and more pressure on the weakest points in the system until something finally snaps. Another potential trigger is a simple economic slowdown or recession. When the economy shrinks, corporate profits fall. When profits fall, companies that are loaded with debt can no longer afford to make their payments. This leads to defaults. A wave of corporate defaults could be the first domino, leading to losses at the banks that lent them the money and creating a ripple effect of fear throughout the market. Remember, many of the valuations we see today are based on optimistic guesses about future earnings. If those earnings don't show up because of a recession, the market's entire justification for its high prices vanishes overnight. And finally, there is the risk of a black swan event, an unexpected shock that comes out of left field and shatters market confidence. It could be a new geopolitical conflict, a sudden energy crisis, a major cyber attack on the financial system, or even a political crisis like a contentious trade dispute. The key thing to understand is that in a system as leveraged as ours, the trigger doesn't have to be huge. A small, unexpected event can be enough to start the avalanche. This is where the cascade of forced selling becomes the main event. So, picture this. One of these triggers happens. A large, leveraged hedge fund gets caught on the wrong side of a trade and has to start selling assets to cover its losses. This initial sale pushes prices down a bit. But that small dip is enough to trigger the first round of margin calls for thousands of smaller, speculative investors. Many of them can't meet the call. Their brokers automatically sell their stocks, flooding the market with more supply and pushing prices down further. Now, computer algorithms at other funds, programmed to sell when prices break below certain technical levels, kick in. They start selling automatically, adding to the downward pressure. This new, sharper drop triggers margin calls for an even larger group of investors and funds. More forced selling hits the market. Fear starts to spread. People who aren't even on margin start selling, just trying to get out before things get worse. This is the cascade. It feeds on itself. Selling begets more selling. The market's logic is no longer about a company's earnings or the economic outlook. It becomes a purely mechanical process of liquidation. This is how you get those days where the market drops 5%, 7%, or even 10%. It's the debt bomb exploding in real time. After laying out a scenario this grim, the obvious question is, what can you actually do about it? How do you prepare for a potential deleveraging event and the market crash that could follow? Let's be clear. This is not about predicting the exact day or week the market will turn. Anyone who tells you they can do that is lying. Markets can stay irrational longer than you can stay solvent. This is about managing risk. It's about recognizing the flashing warning signs and positioning yourself to be resilient, not wiped out. The solution is to get informed and get prepared. The first strategy many long-term investors consider in an environment like this is de-risking their portfolio. This means systematically cutting back on exposure to the most speculative, high-leverage parts of the market. This could be story stocks with no earnings, hyper-growth tech companies trading at insane valuations, or any asset that has been driven purely by hype instead of fundamentals. The assets that shoot up the most in a bubble are almost always the ones that crash the hardest. The second, and perhaps most powerful strategy, is to build a cash position. In a market crash, cash is not trash. Cash is king. Cash gives you options. It's a buffer that lets you weather the downturn without being forced to sell your own assets at the worst possible time. More importantly, it provides the dry powder to take advantage of the incredible opportunities a crash creates. When everyone else is being forced to sell, a person with cash can swoop in and buy high-quality assets at bargain basement prices. As Warren Buffett famously said, the key is to be fearful when others are greedy, and greedy when others are fearful. You can only be greedy when others are fearful if you have the cash to do it. Third is the principle of true diversification. For years, investors have been told a 60-40 portfolio of stocks and bonds is, quote, diversified. But in a rising rate environment where both can fall at the same time, that may not be enough protection. True diversification means looking across different asset classes that behave differently during a crisis. This could include assets like physical gold or other hard assets that tend to hold their value when financial turmoil hits. Finally, and most importantly, This is a time to focus relentlessly on fundamentals. In a debt-fueled bubble, almost everything goes up. But in a crash, a great separation occurs. Companies with strong balance sheets, low debt, and consistent, reliable profits will be far more resilient than over-leveraged companies that need cheap capital just to survive. A portfolio built around profitable, durable businesses is your best defense against a market storm. These are the companies that will survive a downturn and thrive on the other side. Ultimately, navigating this environment comes down to a mental shift. You have to move away from the get-rich-quick, speculative mindset of a bull market and adopt the capital preservation and opportunistic mindset of a bear market. Staying informed is your best defense against what could be coming. The financial landscape is changing fast, and understanding these deep-seated trends is no longer optional. If you want to keep up with these developments and learn more about how to protect and grow your wealth in uncertain times, make sure you subscribe to the channel and hit that notification bell. And if you want to take your investing or trading game up a notch, feel free to sign up for my Macro Investors Mater class. The link is in the description, and the first module is absolutely free. I've also broken down how central banks might try to respond to a crisis like this in another video, which is the perfect next step to understanding the bigger picture. You can watch that right here. The picture is alarmingly clear. The global economy is saturated with an unprecedented amount of debt. This leverage has fueled a speculative bubble in financial assets, pushing valuations to historic extremes that mirror the conditions right before the crashes of 1929, 2000, and 2008. The combination of record national debt, soaring interest payments, and a record level of speculative margin debt has created a system that is incredibly fragile. All it needs is a trigger, be it higher interest rates, an economic slowdown, or an unforeseen shock, to set off a catastrophic cascade of forced selling. This is not a prediction of doom, but a plea for prudence. The warning signs are all here for those who are willing to see them. Being prepared doesn't mean hiding under a rock. It means understanding the risks, adjusting your strategy, and being ready to act when others are paralyzed by fear. I want to leave you with a question. What are you watching as the biggest red flag in the market right now? Is it the national debt, corporate leverage, or the speculative fever in the markets? Let me know your thoughts in the comments section below.